The Nasdaq is a virtual listed exchange where all of the trading is done over a computer network. The process is similar to the New York Stock Exchange. However, buyers and sellers are electronically matched. One or more Nasdaq market makers will always provide a bid and ask price at which they will always purchase or sell their stock. The Paris Bourse, now part of Euronext, is an order-driven electronic stock exchange. It was automated in the late 1980s. Prior to the 1980s, it consisted of an open outcry exchange. Stockbrokers met on the trading floor, and in 1986, the CATS trading system was introduced, and the order matching process was fully automated. From time to time, active trading, especially in large blocks of securities, have moved away from the active exchanges. Security firms led by UBS AG, Goldman Sachs Group Incorporated, and Credit Suisse Group already steer 12% of the U.S. security trades away from the exchanges to their internal systems. That share will probably increase to 18% in the near future as more investment banks bypass the New York Stock Exchange and Nasdaq and pair their buyers and sellers of securities themselves, according to data compiled by the Boston-based 8 Group LLC, a brokerage industry consultant. Now that computers have eliminated the need for trading floors like the New York Stock Exchange, the big board, the balance of power in equity markets is shifting. By bringing more orders in-house, where clients can move big blocks of stocks anonymously, brokers pay the exchanges less in fees and capture a bigger share of the $11 billion a year that institutional investors pay in trading commissions. Market participants include individual retail investors, institutional investors such as mutual funds, banks, issuance companies, and hedge funds, and also publicly traded corporations trading in their own shares. Some studies have suggested that institutional investors and corporations trading in their own shares generally receive higher risk-adjusted returns than retail investors. A few decades ago, worldwide buyers and sellers were individual investors such as wealthy businessmen, usually with long family histories to particular corporations. Over time, markets have become more institutionalized. Buyers and sellers are largely institutions, i.e. pension funds, insurance company, mutual funds, index funds, exchange-traded funds, hedge funds, investor groups, banks, and various other financial institutions. The rise of the institutional investor has brought with it some improvements in market operations. There have been gradual tendency for fixed and exorbitant fees being reduced for all investors, partly from falling administration costs, but also assisted by large institutions challenging brokers' approach to setting standardized fees. Stock market participation refers to the number of agents who buy and sell equity-backed securities, either directly or indirectly, in a financial exchange. Participants are generally subdivided into 3 distinct sectors: households, institutions, and foreign traders. Direct participation occurs when any of the above entities buys or sells securities on its own behalf on an exchange. Indirect participation occurs when an institutional investor exchanges a stock on behalf of an individual household. Indirect investment occurs in the form of pooled investment accounts, retirement accounts, and other managed financial accounts. This is the end of this video. Please proceed to the next video.